Good evening. I'm Anna Tragister. I'm the Artist and Community Services Manager at the Indiana Arts Commission. Some familiar names out there, so glad that you all are here. If you wouldn't mind, take a moment and down at the bottom of your screen, there's probably a little menu bar that pops up when you hover near the bottom with the little message icon that says chat. Could you chat to everyone and tell us your name and where you live? We're glad that you're here. I am really excited for you to hear from Elaine Grogan Luttrull tonight. Elaine will tell you a little bit more about what she does, but she is a real asset to Indiana, and she serves artists here in lots of different ways and has been a professional serving artists across the country in lots of ways that we don't quite know what to do with, right? Retirement, taxes, and everything else that surrounds what makes our practice and our lives sustainable and thriving. So I'm excited for you to hear from her. We are recording this webinar. It will be posted online in the coming maybe week or so. I'll send you an email when the recording is ready, and the slides will be available as well. This is going to be a series of webinars. So the next webinar we have coming up with Elaine is in, I believe, February. Am I right, Elaine?
That's right.
Is that right?
Yes, exactly.
In February. So perfect timing to jump back into taxes. And the other thing that you should know is that Elaine teaches our On-Ramp Creative Entrepreneur Accelerator, which has been a really incredible program to witness artists growing from across the state together in business skills and entrepreneurship. And On-Ramp is currently accepting applications. You can find it on our website, On-Ramp, and applications are due by January 16th. We're also accepting applications for the Individual Advancement Program, which is a career development grant. Those applications are due February 6th. And if you don't know what to do with grants, we're here for that. Here for that all the time by email and by phone, but we're also going to be traveling the state in December. We're doing some grant writing pizza parties, so you're not going to want to miss those. You'll be receiving more information about the final dates. I'll give you a little sneak peek here. We'll be meeting up in Fort Wayne, Bloomington, Muncie, Chesterton, Terre Haute, Lafayette, Goshen, Evansville, and Columbus. And so just stay tuned for those dates, but we're gonna be out there. It's gonna be a lot of pizza, and ultimately, by the time that you leave that pizza party, you'll know whether you should apply for a grant, which a grant to apply for, and we want you to get started right away. So you should bring your laptop to those, and we'll just get you started. What could be better? So without further ado, let's dive into retirement. And please give it up in your homes for Elaine Grogan Luttrull.
Thanks so much, Anna. I appreciate that. And I will echo Anna's sentiments. It's so nice to see so many familiar names popping up on the participant list. So welcome to everyone to the IAC's webinar this month, Retirement Secrets. This series and the On-Ramp program and all the amazing work that Anna and the team does would not be possible without the support from the Indiana Arts Commission. So huge thanks to them, and Anna in particular. You all as Hoosier artists have such an asset in your state arts commission and in Anna and everyone on the team who supports everything you do. So huge thanks to them. For those of you that don't know me, my name's Elaine. It is lovely to see you all. As Anna mentioned, I lead the On-Ramp program that happens in May of each year, and I'm looking forward to meeting a handful of new artists this coming May. When I'm not doing that, I am traveling around the country helping other creative individuals with the business side of their creativity. My area of expertise is finance and money. I am a CPA by training, and I have a PFS designation that stands for Personal Financial Specialist, and I'm an accredited financial counselor. I also finished a program in financial therapy a couple of years ago. So I like to say that I can hand you tissues as we cry together about taxes and retirement and budgeting and financial planning and all of that other stuff that is hard for everyone, but it's especially hard in a creative context when income fluctuates so irregularly and when there are nuances to tax deductions and when you're probably juggling multiple jobs or multiple roles and when what you're doing is so personal that it's sometimes hard to articulate the value or the price for what you do. So I am the luckiest CPA ever in the history of CPAs because I get to have these conversations all over the country with state arts councils and commissions, with funding groups that give out grants that come along with support from financial professionals and legal professionals, and then at colleges and universities that are educating the next generation of creative entrepreneurs so that they can start changing some of these habits and learning some of this information before they even enter their careers. So what are we doing tonight? We're talking about retirement, of course, but you probably knew that. More specifically, we'll make sure to list the types of retirement plans that are available, with particular focus for those that are available for individuals who are self-employed. That's you, probably, if you have any income derived from your art. We'll also talk about the amount you should be saving, just to figure out kind of if you're on track and maybe what are some tools to help you check in with that. And then we'll go over some basic vocabulary terms so you feel like you have a handle on some of this. Of course, this information is educational in nature and not intended to be construed as tax, legal, or accounting advice. And a quick reminder, this is being recorded. So to the extent possible, make sure your questions, you're comfortable with your questions being recorded when and if you have them. And also know that the information is current as of the recording date of this webinar, but it might not still be current 5 or 6 years into the future. Just in terms of some ground rules, thank you all for being here. It looks like everyone has themselves muted, so you already know all about good webinar etiquette. If you do have questions or you would like me to dive a little bit deeper into something, feel free to type that into the chat. The chat box, if you missed the first couple minutes of the webinar, you can hover your mouse at the bottom part of your menu and there's a little icon that pops up. You can click chat. That's where we'd love for you to introduce yourself and then share where you are watching this webinar from, so the IAC can have a sense of who's here and where they're watching from. And also that's a good spot to put your questions if you have any. Of course, the other general ground rules that apply anytime I'm doing workshops like this are respect. We always want to make sure we are sharing the floor and treating everyone with respect, which I know you will do. I'd also like to acknowledge that you are all experts in your own experience. So that means the information I'll share might perfectly apply to your situation, or it might not. But in either case, you are in charge and you get to be the expert in the decisions you make and the next steps you take following this webinar. So remember that. And then lastly, stories stay, but the lessons should leave and go with you. So if someone does share a story about something they're experiencing as part of retirement or saving for retirement, definitely make sure that person can share their own story, but you can retain the lesson and take that with you. So the first question I thought it would make sense to cover is, why in the world should you even bother saving for retirement? Sometimes I'll work with creative individuals who never want to retire. And I get that. If I'm being perfectly honest, I never want to retire either. I want to keep doing on-ramp until I'm, 107 years old, or however long I'll be able to keep hanging out in Indiana doing that. But just because you want to do something doesn't necessarily mean that planning to do something forever is the right strategy. So the first thing we want to talk about, and the number one reason why you should be saving for retirement, is to start accumulating that financial security, right? Generally speaking, we're pretty comfortable knowing that you should be spending less than you're bringing in on a regular basis and using creative ways to figure out how to make your budget work so that you're having positive net income instead of negative net income or a net loss every year. And that's great, right? You're living within your means, but the real secret to that is that as you have that positive net income, that gets added to your savings or your retirement accounts or your other assets, the other stuff you have, and that creates accumulation of wealth. That basically grows your net worth because the stuff you have keeps increasing and the amounts you owe to other people, your liabilities, generally speaking, go down over time as you continue paying them off. So that saving, living within your means and putting that extra into some sort of pot does enable you to start accumulating that wealth. And then that wealth turns into assets that provide income for you in the long run, whether it's through the generation of additional assets So that idea of compound interest or compound savings means maybe you've gotten $100 and you have it saved and it's sitting in a savings account and it's earning 1% on that $100. At the end of 1 year, you have $101. And then at the end of year 2, you have more than $102 because you're earning interest on the interest. Now, at 1% in a savings account, it's not super exciting, right? And you can see it takes a long time for that compounding interest to add up. But the more you save and the more you earn, the more you add to those additional assets that then generate additional income for you later in life, in the case of retirement, or before retirement, in the case of just saving and accumulating wealth in an emergency fund or something else that you're just preparing for whenever you might need it. And of course, if you have that accumulation of wealth, or if you have that plan, if you are working toward building those assets, you get to do whatever you want, right? You never have to say yes to a project you'd rather say no to just for the money. You have this financial freedom and this financial security that can lead to creative security. And ultimately, that's my hope for you all. So with that in mind, how much are you supposed to be saving for retirement? There are so many different answers to this question, but I want to start by kind of grounding us together in this idea of, if you step back and just think about what your financial health looks like. You've got the cost to exist as a human in the way you want to exist, and maybe you have kind of a sense of what that is. Then you have the cost to run your studio or your creative practice in the way you want to run it. Maybe you have a sense of what that is as well. And then, you know, as someone who's self-employed, you are probably paying a lot in taxes. So you're adding that tax amount to those other costs you're paying. And then you're saying, okay, I know I should be saving for the short term for, say, an emergency fund, or for a project I want to do, or for some short-term goal. And then you should be saving for the long term as well, maybe for something like retirement. So if you think about all those numbers and the amounts that you know and the amounts that you might aim to save or spend on taxes, if you add all of that up, then we get to your target income amount. So the amount that you aim to earn on a regular basis, whether we're looking at this over a year or over a month or 6 months, whatever time frame you're comfortable with. But if you've been through budgeting workshops with me before, you know I always favor starting with the expense side and then figuring out how to fund the realistic expenses you'll have. Because if we don't start counting in taxes and especially savings, before you know it, we're not making enough to cover all of that. We're just making enough to cover the costs to run our studio and our creative practices and our lives as humans. And that's not enabling us to accumulate any of that net income or that wealth over time. So by adjusting our framework to say, okay, we know we should be saving, we know we should be paying taxes, and we know we have these realistic costs for our lives and our creative practices, that can kind of reset your income goal. And then we figure out how to make that amount of money so that you're covering your retirement. And what should that be? General wisdom says you should be aiming to save 10 to 15% of what you earn every year for retirement. So if we were to look at this graphically, right, if you're making this much, the first 15% is going to your savings, then maybe 30% or so is going to your taxes. And then what's left is only about 55% of what you've earned to cover your studio costs and your costs to exist as a human, right? And so by planning for it that way, we make sure the savings is happening first and the taxes, so that then we have enough left over for the other costs. Because if we do it the other way, you almost never have enough left over to save. And that's why many times people struggle to accumulate wealth. You will not save for retirement by spending less on your studio practice, but you might be able to get there by reframing your income goals and figuring out the pricing strategy and portfolio career framework that works for you so that you can reach that goal. So 10 to 15% of what you earn is a good benchmark for what you want to save on an annual basis. And another way to think about what you want to save for retirement is to look at your current costs. And here you see I've called out the cost to exist as a human and your cost to run your creative practice. Because for many individuals, they want to continue making work well into retirement. So you're still going to have materials costs and maybe website hosting expenses, maybe show fees or application fees. You're still going to have all the costs associated with your creative practice if you want to continue doing it. And if that's the case, what we want to do is look at your realistic costs right now. And then a good benchmark is to say, okay, let's aim to figure out how we replace 80% of that with income in retirement, which is kind of a confusing concept, right? The theory is that some of the costs you have now might not exist in retirement. Maybe you have paid off your home by the time you have retired, so you no longer have that house payment. Or maybe you have paid off your student loans, so you no longer have that as an expense in your cost to exist as a human. So the idea is, if we can figure out a pot of money that will yield enough income to pay for 80% of your expenses in retirement, that's a pretty good model. It's a good sort of frame of reference or a good quickie rule of thumb if you aim to replace 80% of your income. The third thing you can do, and honestly, this is my favorite approach because it relies on a little bit more thought and intention instead of some of those benchmarks or rules of thumb, is to sit down and take a moment and say, okay, what are my costs going to be in retirement? You know what your costs to exist as a human are now. How are they going to be similar or different in retirement? Maybe you'll have comparable living expenses, or maybe they'll be higher or lower. Maybe you'll have more travel expenses. Maybe you'll have more entertainment expenses if you want to take up a new hobby in retirement or something like that. And what about your studio? What expenses are you going to have to run your studio in retirement? Are they going to be the same, or might they be higher or lower? By starting with your current expenses and then adjusting them based on what you think retirement will look like for you, that can give you a better sense of what the actual costs of your retirement are going to be. Now, this approach I like because it does have that intentionality associated with it, but it's a lot more work. So if you are 22 years old, start with one of the rules of thumb. Aim for 10 to 15% per year. If you are maybe 60 or 65 and retirement is a little bit closer to your horizon than it might be for someone who's quite a bit younger, in that case, maybe you do spend the time to say, okay, what is my retirement really going to look like? What might my healthcare costs be? And how am I going to fund those? Because at that point, you have more solid information that might make the exercise a little bit more intentional, and it might work a little bit better for you. I'll pause here just to check in the chat to see if there are any questions about this. Doesn't look like any questions so far. I think that's good. So let's recap this for a second. How much are you supposed to save? You've kind of got three options to estimate this. One, you can build a budget based on what your real retirement will look like. That's fantastic, but it's a lot of work. Two, you could aim as just sort of a quick rule of thumb to cover 80% of your current expenses in retirement. And that might give you a good general sense of how much you might aim to save. Then in the current year, as you're planning, a good rule of thumb is to aim to save 10 to 15% of your income for retirement. There are lots of ways to kind of check in with those numbers or dig a little bit deeper. One way is using an online retirement calculator. This is a screenshot from NerdWallet's retirement calculator. NerdWallet has a lot of fantastic resources, and this is one of them I really like. You can see I've sort of called out in orange boxes the variables that you can change. If you go to this website, you can enter your age and your income and how much you've saved on average, and NerdWallet has this calculator that bakes in a whole lot of assumptions about how much that current savings will grow and how much of your income you'll need to replace in retirement. And it gives you an estimate of how much you would need to retire at age 67. And here, based on what I've entered, you can see it's about $510,000 or so. And based on how much this person has saved currently, they're a little bit short of that. So they need to continue saving, right? So if you're looking for a quick way to kind of check in and see, using one of these existing tools, how you're doing, this is a really good one I like. The Consumer Financial Protection Bureau also has a tool that I like a lot. It allows you to estimate the Social Security income you'll have in retirement, and you can consider that as a potential replacement for some of that income. So that's at cfpb.gov or consumerfinance.gov. And the Department of Labor has a lot of great resources as well. That's at dol.gov. And they have educational resources and then various calculators and tools you can kind of play around with. So I'd encourage you, as we're approaching the end of this year and you're thinking about maybe making some contributions to some retirement accounts before the end of the year or before you file your taxes for 2019, go ahead and check in with where you stand currently when it comes to your retirement and see if you need to be setting aside a little bit more, or if you're in pretty good shape, or if this is all new to you and you're still in the gathering information phase, that's okay too. But just taking stock of where you are is a good way to kind of say, okay, here's where I am and here's what I'm going to do going forward. So those are some great resources I would encourage you to check out. And of course, please remember to stay flexible, right? There are so many tools available, but your income will fluctuate quite a bit over time. You as creative individuals know that better than anyone. You might have a fantastic year where you have a whole lot of income, and then you might have a year where things aren't quite as robust. And so aiming to save 10 to 15% of what you're earning might be a lot easier in a very good year and quite a bit harder in a very lean year. And then the added challenge there as well is, if it is a really good year and you're planning to invest back into your creative business, how do you weigh the trade-off between investing in a new piece of equipment, or maybe expanding your studio, or maybe traveling more or applying to more shows? How do you weigh that need against your long-term need for retirement? And so those are the things you need to be thinking about as you're going through this process. Because if your goal is to save 10 to 15% every year, that's awesome. But that number can vary pretty wildly. So just make sure you're paying attention to it and acting with intention when it comes to saving, rather than just assuming it'll take care of itself in a future year. The other thing to remember is that your needs will probably change over time, right? As you get closer to retirement, your needs might be a little bit more clear, but depending on what might happen with your family or with your personal relationships or geographically where you might live, your needs could be vastly different in retirement than you expect today. So remember to stay flexible and keep checking in with some of those benchmarks as you get a better idea of what you really want your retirement to look like. Also know that you can absolutely plan for a very long retirement. Many financial planners or models for retirement are built assuming that someone will retire at some point in their 60s and live to be at least 100 years old, right? That's a pretty long period of time to cover with retirement savings. So if you are planning to be retired for only 5 or 6 years, right, and you end up being retired for quite a bit longer, obviously that will impact the amount of money you need. And the same is true if you decide to retire a little bit earlier, whether you are choosing yourself to retire, or maybe retirement is maybe forced upon you if you are unable to work or unable to work in the same capacity, or you're choosing to work less because of family commitments or something like that. So remember to stay flexible. This is just good advice, and you need to kind of keep paying attention to it, maybe about once a year or so as your needs change. I see a question in the chat. Thanks, Becky. It says, due to the income fluctuations of a freelance career, I do end up accumulating credit card debt to cover the in-between times. Absolutely. Yes. Thank you for sharing that, because that is a very, very real struggle. Do you have suggestions for how to manage those fluctuations, pay down debt, and still be able to save for retirement? That's such a fantastic question, because it gets to the heart of the idea of only being able to accumulate wealth as those liabilities go down. So the tension very often is between saving for tomorrow versus paying current expenses or paying down debt from previous expenses. And so it's hard. It is really, really very hard. Some people might tell you to only pay down the debt, because once there's no debt, then you'll be able to save. And I think if you're at a point where there's some predictability to your income, whether it's from a slightly more stable job where you're earning money on a regular basis, maybe related to your art, or because you're established enough that you are able to kind of predict what type of income you might earn from your art. If that's the case, yeah, maybe the right answer is to prioritize paying down debt. But my worry is that paying down debt at the expense of saving for retirement means that you will likely be in a situation where you will need to take on more debt because you may not have resources available to cover those expenses. And that kind of brings up a related point to your question, which is the idea of saving for some sort of emergency reserve fund and saving for retirement. And how do you prioritize those two things? Personally, I really favor prioritizing saving for an emergency reserve fund. That way you have a small pot of money that you can access when and if you need it. And that's really important to get through those bridge times when you maybe have a slower season, or you aren't earning quite as much money, or you have an unexpected expense that you have to cover for your studio or for your personal life. So having that emergency reserve fund is really, really important. And once you've got that, or once you have that starting to grow a little bit, it can also be really helpful to start saving for retirement as well, while you're making your on-time credit card payments. Because remember, the number one thing that affects your credit score is paying those bills on time. So if you make sure you're still making payments, ideally more than the minimum payment, but absolutely still making the minimum, then your credit is still going to be okay, at least from an on-time payment perspective, and you can be saving for retirement and saving for that emergency reserve fund. But it is sort of a juggle and a struggle, and sometimes there's some tension there. Thanks for that question. So, how are you supposed to do this? We know you need to. We maybe have a sense of what those amounts should be. The good news is that you, as a self-employed person, have some additional options to save for retirement. And the even better news is that those are pretty good for you from a tax perspective. So if the trade-off is between paying more in taxes and saving for retirement, I'd prioritize saving for retirement to minimize that tax burden. So the most common way most people save for retirement is through some sort of employer benefits. If you are fortunate enough to have some sort of W-2 job where you have retirement benefits, either the ability to take a little bit out of each paycheck and put it towards your retirement, or an opportunity to have your employer match your contribution, go ahead and maximize that. Right? That's a really great thing to do. And it's really easy to do anytime you are making teeny tiny small changes to how much is being withheld from each paycheck. You might not notice them. And then before you know it, that money can start subtly growing and accumulating over time. Sometimes also, if you have a W-2 job and maybe you get the news that you are getting a raise, even if it is not a huge raise, that's a really good time to increase the amount that you are withholding from each paycheck for retirement, because then you won't notice it at all. You'll still get the same take-home pay, but you'll have the additional amount going to your retirement. So if you have a W-2 job and there is the infrastructure there set up for some retirement savings, take advantage of that. And absolutely take advantage of that if the employer matches any of your contributions. Many people who work in the nonprofit sector often accept lower salaries than they might if they worked in the for-profit sector. But working in the nonprofit sector often comes with some pretty fantastic benefits to working for nonprofits. And one of them is these generous matches that come with retirement contributions. Now, if times are tough or if it's a relatively small nonprofit, the retirement contribution match might be the first thing to go. But if you work for a college or a university or a larger institution, it's pretty common among nonprofits for the nonprofit to match a percentage of your contribution to your retirement. And so that basically means they're giving you free money. It doesn't always feel like it because you don't get it until many, many years down the road. But if, say, you decide you are going to contribute 6% of your salary to a retirement plan, maybe it is a 403B or a 401k type of account, your employer could match that and say contribute 3% of your salary. Now, that's not additional money coming out of your salary, that's coming out of the employer's pocket, but it's going into your retirement account. So if there is an opportunity for free money, you should take the free money, right? And one of the benefits of working for an institution or a company is that they may have the infrastructure to handle this type of retirement account, so take full advantage of that. Again, that's the most common way many individuals save for retirement, so if it's available to you, take advantage of it. The next most common way is through individual retirement accounts. Now, these tend to be outside of your employer. They are accounts that you set up, and these amounts are not being withheld from your paycheck. Instead, you're taking money that you have earned and been taxed on, and then you're contributing up to $6,000 a year into an IRA, an individual retirement account. If you are older than 50, you get to contribute $7,000, which is kind of nice. They call those catch-up contributions since you're a little bit closer to retirement. There is a tax deduction that you get for this contribution, and depending on how much income you make, you may or may not get the entire amount of the deduction, but that's okay. If you're a single individual and you are deducting or you are contributing $6,000 to your IRA in 2019, as long as you are making less than about $63,000 or so, that whole amount is deductible to you. Above that level for a single individual, the deduction starts being phased out, but that's okay. It's still a good thing to do, even if you don't have the deduction to claim. Within an IRA, you have what we call tax deferred growth. So this money in the account grows, and as it is invested, it earns money each year. And remember, that money earns more money because of compounding interest. But you don't pay taxes on any of that growth in the account until you take the money out once you're in retirement, which is pretty great because in theory, when you're retired, your tax rate, the rate at which you pay tax on all of your income, will probably be lower because for many individuals, your income in retirement is quite a bit lower. And there's some strategies to manage that so that you can withdraw enough to stay below some of those income thresholds to minimize your taxes in retirement. So once you have maximized your employer benefits associated with retirement, opening up an IRA is a really good option for a lot of individuals. You can do this as well with or without an employer. It's a really good option. The last option for you has to do with these self-employed retirement plans. And this is really the crux of our conversation tonight. As someone who is self-employed, and if you are a creative individual that is in the business of being creative with the intent to make money from your creativity, you're probably self-employed, right? So that means you're reporting income that you're earning throughout the year, and then all of your ordinary and necessary business expenses associated with that income. That's you being self-employed. That comes with a high tax burden, but it also comes with these special retirement benefits that you can maximize. So we're going to talk about two main plans, both of which could be options for you as you kind of take stock of where you are and figure out what you might want to do for your retirement long term. The first option is called a SEP. It stands for Simplified Employee Pension. And I love this because it really is simplified. If you decide as your own employer, as someone who is self-employed, you want to open up a SEP, what you have to do basically is adopt a written plan, and it allows the business owner, that's you, to make contributions to your own retirement. If you have employees, you can make contributions to their retirement as well. And you get to do that in a pretty simplified manner. A SEP gives you a lot of flexibility because it doesn't require you to make contributions each year. So if you're having a great year and you want to make a contribution through a SEP, that's fantastic. If not, you can make a much smaller one or maybe none at all if your plan permits that, right? So you have a lot of flexibility. Each employee has their own SEP IRA account. And remember, if you are self-employed, you get one of them. And then it's the business that makes the contribution to your own SEP IRA. So that means you're thinking about your business income and your business expenses, and then the net amount is essentially what you get to keep to fund your life. And you can choose as the business owner to add an extra business expense to then reduce that amount and invest in your own retirement. And that's deductible, which is a pretty fantastic thing. The timing on a SEP is pretty flexible. You can open up a SEP as someone who is self-employed anytime before you file your tax return. So that means as you're looking at 2019 and you're saying, okay, it's a pretty good year, and this might be a really good time for me to take advantage of some of these tax savings for retirement options I have as someone who's self-employed, you can open up your SEP IRA anytime before you file your tax return next spring. So there's a lot of flexibility associated with this. So how much can you contribute? You can't contribute more than $56,000, so I apologize. You also can't contribute more than 25% of your compensation. Now, for many individuals, 25% of your compensation ends up being the more realistic limit, but by all means, if you were able to contribute $56,000 or up to that, you should maximize that if that's your situation. So as you're thinking about being self-employed, sometimes it's a little weird to use the word compensation, because if you are a sole proprietor or a single member LLC, you're not paying yourself a salary at all. You're just earning money from your business. And luckily, that's exactly how the IRS defines compensation if you are self-employed. So the IRS looks at this figure they call net earnings from self-employment. And at its most basic, it looks at the gross income from your trade or business, so you're earning from your creativity, and then it subtracts all the ordinary and necessary business deductions. That bottom line amount is your net earnings from self-employment. So that's the number we would multiply by 25% to see what your SEP IRA contribution limit would be for the year. So let's look at what that might look like in a hypothetical example. Let's pretend you are a musician and you earned $36,500 from various gigs this year. It was a pretty good year for you. Your ordinary and necessary business expenses are $14,000. And as you're looking at your income and expenses for 2019, you say, you know what? I need some of the money just to pay for living expenses, but I think I can set aside $3,500 for my retirement. And maybe you're using that because that's close to 10% of what you earned for the year, $36,500, or maybe that's just a number that feels right to you. Regardless, you would say, okay, I'm gonna try to set aside $3,500 in my SEP IRA. So then we add that amount to your ordinary and necessary business expenses. And so the whole business has expenses of $17,500 for the year. We take your income, $36,500, minus those total expenses, including your SEP IRA contribution. And that gives us your net earnings from self-employment of $19,000. That's the amount we then calculate the limit based on. So $19,000 times 25% is $4,750. The amount you want to contribute, $3,500, is less than that, so you are totally good to go, right? You are allowed to contribute $3,500 from your business to your SEP IRA account for 2019, and you haven't hit any of those thresholds. Congratulations, that feels pretty good. So then we talk about where this goes on your tax return. If you are a self-employed musician, you are probably filling out Schedule C. So when you fill out your Schedule C, you're going to show your income from all those gigs of $36,500, and then you're going to show your ordinary and necessary business deductions of $14,000. You don't put the SEP IRA on your Schedule C. It goes somewhere else. We'll get to that in a second. So that means you have $22,500 of net income from your business. You report that on Schedule C, which gets attached to your tax return. And then that amount flows onto Schedule 1, which I've reproduced here, and it goes on line 12, business income for the year. And of course it says attached Schedule C, because that's all the detail, right? Then that Schedule 1 gets attached to your Form 1040. It's kind of like a domino process, but if you're patient and watch everything flow through, it really does all end up in the right spot. Then we keep going down on Schedule 1, and that's where you report the contribution to the SEP IRA from the business, right? It is still deductible to you. It shows up there right on line 28. That's where the business contribution to the SEP IRA gets deducted, which is great. And you'll see that's a totally different place from where your IRA contribution is deducted. So let's pretend your business makes a SEP contribution of a couple $1,000s, $3,500 in this example. And let's pretend you say, you know what? From my own personal funds, I also want to contribute $3,000 to my IRA for the year. You can do that because your traditional IRA is separate from your SEP IRA because those contributions are coming out of different pockets. So this is a good way to maximize the tax benefits associated with saving for retirement as someone who is self-employed. The next plan I want to make sure to mention is called a simple plan, and it doesn't always feel simple. We have a question here. The question is, can you put the $6,000 IRA deduction plus the SEP IRA going over the max, or do you still have to stay within the $6,000? No, SEP IRA has a separate max. It's calculated completely differently from your traditional IRA. So you can max out your SEP at whatever amount that is, 25% of your net earnings from self-employment, and max out your traditional IRA for up to $6,000. So it's a way to essentially enable you to save even more for retirement than you could if you were only using a traditional IRA. It's a great clarifying question. Thanks for bringing that up. The next plan is called a simple, and I don't find it to be particularly simple, but the acronym worked. A simple is yet again a written agreement. These plans always have to be in writing, and the agreement says it enables employees to make retirement contributions and then take advantage of an employer match. So when we were talking about the SEP is just the business making a contribution to a retirement account on behalf of its employees or its owner, right? That's the business making the contribution. Under a simple plan, it's the employee that's making the contribution, and theoretically it would be through like a payroll deduction, or if you're not paying yourself, it would just be a percentage of your earnings you're contributing. And then the business matches that in some way. So in this case, it's a little bit different because it's not only the business that's making the contribution. The employee, that's you, the individual, the owner, has to make the contribution and then is enabled to claim a match from the business, which is also you, your creative business, right? So it's a little bit different geographically for how the money flows, but it's still a way to enable you to save for retirement. The timing on this is a little bit different than the SEP plan. Remember, with the SEP, you could make contributions and adopt a plan all the way up until you file your tax return for next year. That's not true with a simple. If you're going to adopt a simple, the business, that's you, has to adopt it before October 1st. So as you're thinking about this, if you're thinking this might be part of what you want to do long term, that would be something for you to adopt starting next year in 2020 before October 1st so that you could start taking advantage of it then, right? We've already missed the window for it for 2019 because we're after October 1st, but you can still start it for 2020 if that makes sense for you. The contributions here are a little bit different. Individuals may contribute up to $13,000, and this amount does count toward your overall limit of how much you can elect to defer to save for retirement in 2019. That amount is $19,000. So if you have a W-2 job and you are having some of your income directed toward a 401k or a 403b, that amount is called an elective deferral, right? You're saving that for retirement and not paying taxes on it right now. The same is true of this simple contribution. So if you have already contributed, say, $15,000 toward another qualified retirement plan in 2019, that means you can only do $4,000 toward your simple plan because your overall limit is $19,000. And the max you can defer within a simple is $13,000. So I'll pause here. That's a lot to sort of take in and digest, because again, if you've got an opportunity to save through an employer that's matching some of your contributions, that's a pretty good thing to pursue. So you should definitely be maximizing the match if you have it. And that's counting toward that overall $19,000 limitation. So just be aware that that might limit your simple contribution. And that's okay, right? As long as you're kind of aware of all of this and making the best choice for you. As part of this simple, right, the company, the employer, your creative business matches up to 3% of the individual's compensation. And remember, compensation for purposes of being self-employed, we define as net earnings from self-employment. So that's your business income minus your business expenses. That's the amount that then we would apply that 3% match to. So let's look at what this might look like for a sculptor. For this sculptor, they earned $24,000 from sales, commissions, and grants during 2019, which is very exciting. All of those are business expenses for this particular sculptor. Their ordinary necessary business expenses total $10,000, so their net earnings from self-employment is $14,000. The sculptor chooses to contribute 20% of their net earnings, so 20% of that $14,000 to the simple IRA, and the contribution then would be $2,800. Then the business matches 3% of net earnings from self-employment. So the business kicks in an additional $420 to the simple. That $420 doesn't count against that overall $19,000 limit, FYI, because that's coming from the business pocket. So the individual is deferring $2,800 worth of income, saving it in a simple, and then the business kicks in an extra $420. So that means the total contribution to retirement is $3,220, which is pretty great. This would be reported very similarly. Again, we assume the sculptor would fill out Schedule C to report their income and business expenses, and then that income would flow right on through to Schedule 1 of their 1040. And then the deduction for the simple plan would also be reported on line 28, and because this is a separate plan from the IRA or from a traditional IRA, if the sculptor separately wanted to make a contribution to a traditional IRA, that would be okay as well. So, how are you supposed to do this? Let's pretend you listen to all that and you're like, yes, totally want to do a SEP or a simple. Excellent, that's fantastic. Both of them require a written plan plus a separate IRA set up for each beneficiary or for each person, right? I've listed a couple forms here. For the SEP, the IRS has Form 5305 SEP. That's a really good guide, and it includes all the specifications you need to adopt in order to have this plan. The simple has Form 5304. That's a good starting point if you think the simple is the best option for you. Remember, the deadline to set up a simple for 2019 has already passed. That deadline was October 1st, but you can certainly set up a simple in 2020 if that's going to make sense for you. And I would encourage you to do a little bit more reading, do a little bit more research, maybe pull the forms so you can get a sense of what they're asking and what the requirements listed are, and then go visit your favorite financial institution, because many banks and investment houses and brokerage houses can help you set up a SEP or a simple or even a traditional IRA, which is pretty fantastic. And then you can maximize those relationships, maybe find another buyer for your art or another member of your community. There are a lot of good benefits there. And if you enjoy working with the current financial institution you have, expanding that relationship probably makes a lot of sense. I see a question in the chat. Thank you for that. The question is, are both of these plans tax deferred? So the simple does have a tax deferred component to it, right? That's where the individual is deferring taxes on that major amount that's being contributed, right? A traditional IRA typically you're investing post-tax income, and it's the investment that is tax deferred. And that is true for the simple and the SEP and the traditional IRA as well. So as that money is growing, it is growing tax-free, and then you pay taxes when it's withdrawn in retirement. I hope that answers your question. The next question is, can you contribute to a SEP while also having a W-2 job with a 401k contribution? The answer is yes, you absolutely can. Now, there is an overall limit, an umbrella limit for what you can contribute to retirement, right? So if somehow you are already hitting that amount through your W-2 job and maybe a traditional IRA or anything else, then if you've already maxed it out, you can't have a SEP. But in my experience, most people are not fully maximizing that. And if you do have self-employment income, remember, you can still contribute up to 25% of your self-employment income to a SEP. So that could be a really good option. Now, if your business is maybe earning, say, $5,000, and then you have $4,000 worth of expenses, your net earnings from the business would be $1,000 for the year. That obviously would enable you to take a much lower contribution to a SEP, but it still might be a really good choice for you to make. And yes, you can do that in addition to your 401k or 403b, as long as you're not going over any of the overall retirement contribution limits. Thanks for that question. I'll pause again just to see if anyone else is still typing a question in the chat. I'll also let you hang out on this page for a second. As Anna mentioned, we will be circulating these slides afterwards so you can refer back to them. But especially if you're thinking about a SEP or a simple, pulling these forms and the instructions to them is a really, really good idea. That way you can start flipping through and seeing kind of what the requirements of this written plan really looks like. It's not nearly as complicated as it seems. And being able to go into your favorite financial institution and ask for help is a really good choice to be able to make. Okay, so that was a whole lot of information. Let's take a moment and just recap some of the key points. The first thing we talked about is why you would want to save. And I assume you're all on board with that since you're hanging out for a Retirement Secrets webinar. But we want to save to accumulate wealth to enable financial security, which then enables creative security because you can do whatever you want if you have reliable sources of income through that accumulated wealth. And then just because, it's just a really good thing to do. How much are you supposed to save? General rule of thumb tells us 10 to 15% of your income per year is a good target to aim for, right? And it's possible, depending on how much income you make, that saving 10 to 15% of your income is way above what you're allowed to defer from taxes in the current year for 2019. That's okay. You don't get a tax benefit for saving more than you're allowed to defer for taxes, but it's still a really good idea to save, right? So even if you have already maxed out what you're able to save for retirement through the tax system, you can still save, and that's probably still a good choice to make if you're fortunate enough to be in a position to do that. The other good rule of thumb we talked about is the goal to save enough to replace 80% of your current costs, right? So that assumes your current costs won't be super, super different from your retirement costs. And your retirement costs may even be a little bit lower than your current costs are. So if you figure out how much to save to generate income to cover 80% of your current costs, that's not a terrible rule of thumb. But as you get closer and closer to retirement and you have a bit more clarity about what retirement is going to look like for you, then you can start putting a little bit more work into modeling out what your retirement is really going to look like from a cost perspective. What is it going to cost you to exist as a human in retirement? Will your healthcare costs be higher? Or maybe will your entertainment costs be higher? What is that really going to look like? And then what is it going to cost you to run your studio practice in retirement? Maybe it's exactly the same as it costs you right now, or maybe things change a little bit and your vision of how you want to work in retirement is a little bit different. As you get closer to making that decision, put in the work to model out what that looks like. So then, how are you supposed to save? Through your employer, if you have that opportunity, so you can maximize their infrastructure, and also, especially if there is a matching contribution available, make sure you are taking full advantage of that, because that's fantastic. If you don't know if your employer has a matching option, it's a really good thing to talk to your HR representative about, and maybe even ask them to consider. You know, things are going okay economically for a whole lot of companies right now, so that might be a really good time to have that conversation. Again, if there is free money available, you should take the free money, right? So maximize the match if that's an option. Then you can also save through your own IRA, your own individual retirement account. The cap for contributing to an IRA in 2019 is $6,000. And you can save through a SEP or a simple plan set up through your creative business. And you're able to do this because you have net earnings from self-employment. That's all that other stuff you do related to your creativity that generates money and also gives you the availability to save for retirement through these slightly different channels. So, what are you supposed to do now? In addition to reviewing the slides and maybe pulling out some of those forms or some of the IRS publications just to kind of review some things, check in with your overall retirement savings and see how you're doing right now. Maybe even gut check to see how your numbers right now compare to some of those benchmarks. And think about your current age, your lifestyle, how long you have until retirement, how long you might want to be retired. All of those things can help you do a little bit of a gut check to see where you are right now. Then, because we're close to the end of 2019, you probably have a pretty good idea of what this year is going to look like financially for you. So that means you probably have a good idea of how much you've earned so far and how much you have spent on ordinary and necessary business expenses. It's not a bad idea this month to spend some time with that information. If you use QuickBooks or another sort of tracking software system, you can run a report to kind of see where you are right now. If you don't, maybe dust off the box of receipts and do a quick gut check just to kind of see where you are, because you have about 6 weeks, maybe 7 weeks until the end of the year. And if you do want to think about saving for retirement, now's a good time to start getting a gut check of how much can I really set aside in a SEP for the year or in a traditional IRA? What is my financial situation going to enable me to do for the rest of the year? As part of this, definitely take full advantage of your allies. Your financial institution, if you like them, is full of humans that love art, generally speaking, and think you are really cool for doing what you do. So being able to go in and have a conversation about maybe starting a SEP and what does that look like could be a really good thing to do. Also, if you have a financial planner or a tax preparer, definitely have these conversations with that person to make sure they're running the numbers with you and providing all the support you need. And then as you are approaching kind of the end of the year, think about what that number is and then go ahead and make that contribution. That way you can contribute to your retirement on the long run and then accumulate your wealth and get to do whatever you want to do creatively until the end of time. I will pause here in case there are any additional questions. As a quick refresher, we listed the types of retirement plans that are available. It was a selection, but we selected the ones that were most applicable to self-employed individuals. We gave you some benchmarks for totals to save each year for retirement, and then we went over some basic retirement vocabulary. I've referenced publication 560 here, 560 from the IRS. It is a great resource that goes through the two particular plans we talked about, the SEP and the Simple, and then a handful of other qualified plans as well. It's a great resource for small business owners, which all of you are as creative entrepreneurs. So I will stick around in case there are any additional financial questions or any other final questions you'd like to throw into the chat. I'll give it a pause and then we'll wrap this up. Becky says, great information. Thank you so much. You are very, very welcome, Becky. I don't see any more typing motions or bubbles. So let's go ahead and close this out. It was such a pleasure spending the evening with you. Huge thanks to the Indiana Arts Commission for making these opportunities possible. My name is Elaine Grogan Luttrull with Minerva Financial Arts. Thanks for spending your time with me, and all the best with your creative work and for that saving for retirement.